Today, the fallout from FTX's sudden collapse continues. Binance plans to launch a fund to bail out crypto projects facing a liquidity crisis. And Kaplan of Prometheum reveals what could prevent the next collapse. Welcome to CNBC's Crypto World. I'm Kate Rooney. Crypto prices are mixed today as the industry still deals with the aftershocks of FTX going under. As of noon Eastern, Bitcoin traded around $16,400, barely moving from the prior 24 hours. Ether, meanwhile, rose by 0.5% to around $1,200, and Solana continued to trade down at $13.50. Citing data from CryptoQuant, Bloomberg reporting that the demise of FTX has sparked an increase in outflows across global exchanges, with users taking out a net $3.7 billion worth of Bitcoin and $2.5 billion of Ether last week. Speaking on a live Ask Me Anything session today on Twitter, Binance's CEO Changpeng Zhao said his exchange has only seen a slight uptick in withdrawals and is operating normally despite a drop in digital asset prices after FTX's sudden collapse. CZ added that this was in line with typical activity during periods of declines in crypto markets. Earlier today, Crypto.com CEO Chris Marszalek tried to downplay concerns of an FTX-like liquidity crunch, saying that his firm had a, quote, tremendously strong balance sheet. In another Ask Me Anything session on YouTube, the CEO said Crypto.com never engages in any irresponsible lending practices and never took any third-party risks. The comments come after the revelation on Sunday that his company mistakenly sent $400 million worth of Ether to another crypto exchange, Gate.io, last month. All right, let's talk about some of the top stories. First, Alameda Research, the trading firm founded by Sam Bankman-Fried, quietly used FTX's customer funds in a way that went unnoticed by investors, employees, and auditors. A source telling CNBC that Alameda was able to use billions of dollars from FTX users without their knowledge and leverage the exchange's native token as collateral. The source added that many employees and outside auditors had no idea FTX didn't have enough money to match its customers' withdrawals. Three sources familiar with the company told CNBC that only a small group knew about the potential misuse of customer deposits. Meanwhile, some FTX users appear to be cashing out of the bankrupt crypto exchange through a Bahamas loophole. Analysis by blockchain analytics company Argus found unusual trading patterns that suggest, quote, desperate customers are relying on FTX users in the Bahamas to withdraw their money. Some have apparently been buying NFTs that seem to be owned by Bahamian FTX users at inflated prices. In fact, a digital collectible that traded for $9 3 weeks ago sold for $10 million. The CEO of Argus says this, quote, NFT activity is highly irregular at a macro level when the NFT market overall is declining, both in value and in volume, and in this specific case when there is limited trading on other FTX markets. Next, the new FTX CEO, John Ray, says the crypto exchange is removing trading and withdrawals, as well as taking other steps following a $477 million suspected hack. A statement tweeted by FTX's general counsel, Ryan Miller, says the bankrupt exchange is, quote, in the process of removing trading and withdrawal functionality and is moving as many digital assets as can be identified to a new cold wallet custodian. The announcement comes as FTX investigates what it calls unauthorized transactions that began within hours of the company filing for bankruptcy protection in the U.S. According to blockchain analytics firm Elliptic, the suspected hack was announced by an admin in FTX's Telegram channel and was followed by a tweet from Miller, who indicated that the wallet movements were not normal. Elliptic found that $663 million in different tokens were drained from FTX's crypto wallets. Of that figure, $477 million was believed to have been stolen in the suspected hack, while the rest was likely moved into secure storage by FTX. Last, the Binance CEO says his crypto exchange plans to launch a fund to help crypto projects facing a liquidity crisis as FTX's collapse reverberates throughout the industry. In a tweet today, CZ wrote that the recovery fund will help reduce further cascading negative effects of FTX to help projects that are otherwise strong but in a liquidity crisis. Earlier today, CZ called for new but stable and clear regulations for the industry. Over the weekend, the CEO tweeted that Binance stopped accepting deposits of FTX's FTT tokens on its platform. On Monday, CZ noted that Binance never shorted FTT. All right, on to our main story. Crypto World's Jordan Smith spoke with Aaron Kaplan, the founder and co-CEO of Prometheum, about how regulation of the crypto industry could evolve in the wake of FTX's collapse.
Can you walk me through a little bit about what happened from the start of November when FTX was considered, the darling of the industry? SBF was considered the white knight of crypto. What led to this collapse that we saw last week?
Overconfidence on all fronts led to the debacle that happened last week. Whether it's first people in the investment, political, or media wanting to anoint SBF as the next JP Morgan. JP Morgan established himself over the course of decades or, almost generations. And what we want to do these days is for some reason to deify people. You can make money by taking advantage of the arbitrage between Bitcoin prices in different jurisdictions. That's different from being an operator who's experienced, who understands the plethora of considerations that go into running a market for digital assets, that go to properly custodying and protecting your customer funds and assets. And what we saw in regards to FTX is that, and in relation to Alameda, is that when things went sideways, there was a lack of institutional controls. There was too close of a relationship between the companies such that it allowed, in theory, if the rumors are right, SBF to potentially pilfer his customer funds and assets at FTX to protect himself from the downside he was experiencing at Alameda. If there had been proper institutional controls in place, if there had been regulation, and there had been proper oversight, this would not have happened.
Which guidelines or regulations seem most pertinent or most likely to be needed right now in the wake of all of this drama?
The best way to mitigate this kind of issue from happening in the future is to apply the existing securities rules and regulations, which are meant to protect investors, ensure fair and orderly markets, and ensure that customer funds and assets are properly segregated and protected. Regulating intermediaries such as virtual currency exchanges and custodians as broker-dealers and requiring them to register under the securities laws provides the institutional controls, reporting mechanisms, and regulatory oversight needed to prevent future debacles. And from the industry standpoint, the regulatory clarity provided by applying the federal securities laws is really what's required to reestablish investor confidence and arguably a prerequisite to entering the crypto winter, as it would increase institutional adoption and establish standards that would allow the industry to continue to grow and expand.
So it sounds like from your answer there that you expect the industry to rely on regulations that are already in place. I mean, we're talking about the Howey test, perhaps maybe the SEC, which is already looking to expand its regulatory guidance over crypto. Do you think that that's more the way to go rather than new laws?
I think existing rules and regulation are the best way forward, as the federal securities laws have been tried and tested over almost approximately 100 years. And they're meant to protect investors, ensure fair and orderly markets, and ensure customers' funds and securities are properly protected. What we've seen is that regulatory shopping almost, or choosing a different regulatory regime, as most virtual currency exchanges have done, either operating as money transmitters or operating in gray zones, hasn't necessarily led to investors being protected. And what's required for the industry to move forward is a regulatory regime that has established standards and frameworks that have been tried and tested. To wait for new laws to emerge or to basically be drafted and go through Congress is going to take a significant amount of time. And furthermore, anyone who has argued that new rules are necessary often need those new rules to fit their business model. Whereas if you understand how the securities laws work, they've been meant to protect investors, to basically ensure that markets have validity and integrity to them, to ensure that customer funds are segregated from the funds and assets of the institution. So if the institution goes belly up, like it did with FTX, customers are actually protected and their funds are still theirs.
What are the likely outcomes for customers who are waiting in line to get their funds? I mean, can you walk us through some of the scenarios there?
It's likely that in this event, the event of a bankruptcy, customers, given my understanding of the user agreement, will become general creditors. And when there is a significantly higher amount of liabilities than assets, and you are one of the last people to get paid, you can't anticipate those people being made whole. At best, in my opinion, they're going to receive a fraction of what they had in there, possibly nothing. which will potentially have more ripple effects and continue to affect the industry until the regulatory clarity we needed is provided.
All right, that's it for Crypto World today. We'll be back again tomorrow with a lot more. We'll see you then.